So in the last part of this chapter, we are going to talk about the Fed's tools of monetary policy. As we have already discussed, the Federal Reserve is responsible for controlling the supply of money. And now we understand how banking works. Now we will understand how banks create money in a system of fractional reserve banking. So as you see from here, the Fed's control of money supply is indirect, because actually banks also have a big role in the creation of money. When the Fed decides to change the money supply, it must consider how its actions will work through the banking system. Okay, the Fed has a variety of tools in its monetary toolbox. We can group all these tools into two groups: those that influence the quantity of reserves and those that influence the reserve ratio and thereby the money multiplier. So we will look at the tools that affects the quantity of reserve, and we will also try to understand tools that influence the reserve ratio, which also influence the money multiplier. So, how the Fed influenced the quantity of reserves? From previous slides, we learned that money supply is money multiplier times the bank reserves. The Fed can change the money supply by changing bank reserves or by changing the supply. The first part of the tools is about influencing the reserve, and when the Fed changes the quantity of reserves, it's actually affecting the amount of money supply in the economy. But the question is how. The first tool is open market operations. The Fed conducts open market operations when it buys or sells government bonds, as I said before. To increase the money supply, the Fed instructs its bond traders at the New York Fed to buy bonds from the public in the nation's bond market. So let me clarify this with the slides. As I said, Fed wants to increase the amount of money, which I will symbolize as money supply in the economy. So what the Fed does, Fed tells its bond traders at the New York Fed to buy bonds, So when Fed buys bonds, it gives dollars to the economy by printing dollars to the economy or to the public. And then in return, Fed gets back bonds, which are papers, bonds. So what Fed does, Fed injects dollars to the economy. So what happens to these new dollars? Some of these new dollars are held as currency and some are deposited in the banks. Okay, there are now new dollars in the economy. Some of them are held as currency, some are deposited in banks. Each new dollar held as currency increases the money supply by exactly $1. So if Fed buys $1 currency, this $1 will increase the amount of money supply by $1, which is the side from the currency. Okay. Each new dollar deposited in a bank increases the money supply by more than $1 because it increases reserves and thereby the amount of money that the banking system can create. As you remember, any dollars that you deposit into the bank, if the banks loan out this money, it can increase the maximum amount of money in the economy, initial deposit times the multiplier. Okay, for that reason, it is important that banking system has a very crucial part in the creation of money, increasing the money supply and applying the tools that the Fed has to the economy. On the other hand, Fed wants to reduce the money supply, What Fed is doing? Fed is just doing the opposite. It sells government bonds. So now the public has bond, and in return, Fed gets the dollars. So Fed is vacuuming the dollars from the public. The public pays for these bonds with its holding of currency and bank deposits, directly reducing the amount of money in circulation. In addition, as people make withdrawals from banks to buy these bonds from the Fed, banks find themselves with a smaller quantity of reserves. In response, banks reduce the amount of lending and the process of money creation reverses itself. So, open market operations are easy to conduct. In fact, the Fed's purchases and sales of government bonds in the nation's bond markets are similar to the transactions that any individual might undertake for her own portfolio. Okay. As you see here, this is very simple tool by selling and buying bonds, so it's easy as long as the bank also add to the money creation, helps to the money creation by giving loans to the people. The Fed can easily increase and decrease the amount of money in the economy. In addition, the Fed can use open market operations to change the money supply by a small or large amount on any day without major changes in laws or bank regulations. Therefore, open market operations are the tool of monetary policy that the Fed uses most often. The second tool that Fed can influence reserve is Fed lending to banks. The Fed can also increase the quantity of reserves in the economy by lending reserves to banks. Banks borrow from the Fed when they feel they do not have enough reserves on hand, either to satisfy bank regulators, meet depositor withdrawals, and make new loans, or for some other business reasons. There are various ways banks can borrow from the Fed. Traditionally, banks borrow from the Fed's discount window and pay an interest rate on that loan called discount rate. So, as you see here, banks can borrow money from the Fed, but there should be some interest on it, which we call the special interest as discount rate. Okay? And when the Fed makes such a loan to a bank, the banking system has more reserves than it otherwise would, and these additional reserves allow the banking system to create more money. The Fed can alter the money supply by changing the discount rate. How? Let's try to understand this in slide. So let's say the discount rate, which I will call it as R, increases. Okay, now borrowing becomes more costly. A higher discount rate discourages banks from borrowing reserves from the Fed. Thus, an increase in the discount rate reduces the quantity of reserves in the banking system, which in turn reduces the money supply. Conversely, when the Fed reduces the discount rate, this will encourage banks to borrow from the Fed, increasing the quantity of reserves and the money supply. In recent years, also Fed, in addition to that, has set up some new mechanism for banks to borrow from it. For example, under the term auction facility, the Fed sets a quantity of funds it wants to lend to banks, and eligible banks then bid to borrow those funds. The loans go to the highest eligible bidders, that's to the banks that have acceptable collateral and are offering to pay the highest interest rate. Unlike at the discount window, where the Fed sets the price of a loan and the banks determine the quantity of borrowing, at the term auction facility, the Fed sets the quantity of borrowing and competitive bidding among banks determines the price. The more funds the Fed makes available through this and similar facilities, the greater the quantity of reserves and the larger the money supply. The Fed uses such lending not only to control the money supply but also to help financial institutions when they are in trouble. For example, when the stock market crashed by 22% on October 19, 1987, many Wall Street brokerage firms found themselves temporarily in need of funds to finance the high volume of stock trading. The next morning, before the stock market opened, the Fed chairman Alan Greenspan announced that the Fed's readiness to serve as a source of liquidity to support the economic and financial system. Many economists believe that Greenspan's reaction to the stock crash was an important reason it had few repercussions. Similarly, in 2008 and 2009, a fall in housing prices throughout the United States led to a sharp rise in the number of homeowners defaulting on their mortgage loans, and many financial institutions holding those mortgages ran into trouble. In an attempt to prevent these events from having broader economic ramifications, the Fed provided many billions of dollars of loans to the financial institutions. So the last tool is about affecting how Fed affecting the reserve ratio, not the reserve bank reserves, but the reserve ratio. In addition to influencing the quantity of reserves, the Fed changes the money supply by influencing the reserve ratio and thereby money multiplier. The Fed can influence the reserve ratio either through regulating the quantity of reserves banks must hold or through the interest rate that the Fed pays banks on their reserves. Again, we consider each of these monetary policy tools in turn. First, Fed sets reserve requirements. One way the Fed can influence the reserve ratios by altering reserve requirements, the regulations that set the minimum amount of reserves that banks must hold against their depositors. Reserve requirements influence how much money the banking system can create with each dollar of reserves. An increase in reserve requirements, let me explain another slide. Let's say now reserve requirements in 10%. So additional $100 of deposit, 10% of it the bank has to keep it in reserve, which is $10, and $90 the bank can create new money by giving this money as loans to the public. Okay. Now with this 10% reserve requirement, the money multiplier will be 1 divided by 0.1, which is 10. So initial $100 will return into the banking system may create maximum amount of $1,000 with this additional $100 of deposit. Let's think about reserve requirement of 25%. Now the Fed says that you have to keep each additional dollar deposit into bank. 25% of it has to stay in your reserve in the bank's vault. So 25% means $100 of additional reserve. $25 will stay in the bank. The bank will keep it. $75 the bank will give as a loan. And given that the reserve requirement is 25%, the money multiplier will be 1 divided by 0.254. So additional $100 will create in the banking system $400 of new money. 300 of new money, 100 is already given, total $400 maximum if the bank loans out whatever left. So as you see, by Fed affecting the reserve requirements, it's actually affecting the amount of money in the economy. By 10% in the previous example, the banks can create out of $100, they can the most create 900 additional more money, and total money supply with that $100 will be $1,000. But with a higher reserve requirement ratio, the money multiplier will be smaller. Since money multiplier will be smaller, the total money created with the initial deposit will be lower. Compare $1,000 and $400. So by Fed changing the reserve requirement, it can actually affect the amount of money that is created through the banking system. Also, Fed can pay interest on reserves. Traditionally, banks did not earn any interest on the reserves they held. In October 2008, however, the Fed began paying interest on reserves. That is, when a bank holds reserves on deposit at the Fed now pays the bank interest on those deposits. So this change gives the Fed another tool with which to influence the economy. The higher the interest rate on reserves, the more reserves banks will choose to hold, right? Instead of giving loan, they will keep it in the Fed and earn interest rate. Thus, an increase in the interest rate on reserves will tend to increase the reserve ratio, lower the money multiplier, and lower the money supply. Because the Fed has paid interest on reserves for a relatively short time, it's not yet clear how important this new instrument will be in the conduct of monetary policy. So what kind of problems we may have controlling the money supply? The Fed has various tools: open market operations, bank lending, reserve requirements, and interest on reserves. They are all powerful and they have powerful effects on the money supply. Yet the Fed's control of the money supply is not precise. The Fed must wrestle with two problems, each of which arises because much of the money supply is created by our system of fractional reserve banking. The first problem is that Fed does not control the amount of money that households choose to hold as deposits in banks. The more money households deposit, the more reserves banks have. But what if the households do not deposit the money into the banking system? Then the banking system will create less amount of money if the households choose to keep the currency not as deposit in the bank. To see why this is a problem, suppose that one day people begin to lose confidence in the banking system and therefore decide to withdraw deposits and hold more currency. When this happens, the banking system loses reserves and creates less money. The money supply falls even without any Fed action. The second problem of monetary control is that Fed does not control the amount that bankers choose to lend. When money is deposited in a bank, it creates more money only when the bank loans it out. But what if the bank does not want to loan it out? So banks can choose to hold excess reserves instead. The Fed cannot be sure how much money the banking system will create. For instance, suppose that one day bankers become more cautious about economic conditions and decide to make fewer loans and hold greater reserves. In this case, the banking system creates less money than it otherwise would. Because of the banker's decision, the money supply will fall. As you see, because of these two problems, since Fed cannot control the household decision and bank behavior, there is always problems with controlling the money supply from the perspective of Fed. And couple of things we are going to talk about this chapter is bank runs, the definition of bank runs, what is it, and its relation to money supply. A run on banks is when people suspect their banks are in trouble, they may run to the bank to withdraw their funds holding more currency and less deposits. Under fractional reserve banking, banks do not have enough reserves to pay off all depositors, hence banks may have to close. Also, banks may make fewer loans and hold more reserves to satisfy depositors. These events increase reserve ratio, reverse the process of money creation, and cause money supply to fall. And when we look at the history, during 1929 and 1933, a wave of bank runs and bank closing caused money supply to fall 28%. Many economists believe this contributed to the severity of the Great Depression. Since then, federal deposit insurance has helped prevent bank runs in the US. In the UK, the Northern Rock Bank experienced a classical bank run in 2007 and was eventually taken over by the British government. And the last thing we're going to talk about is federal funds rate. So what is federal funds rate? On any given day, banks with insufficient reserves can borrow from banks with excess reserves. Okay, the interest rate on these loans is the federal funds rate. So let's say Bank A doesn't have enough reserves on a normal day, then Bank A go ask money to borrow money from Bank B, and the rate that they will borrow money from between the banks is going to be federal funds rate. The FOMC uses open market operations to target the federal funds rate. Changes in the federal funds rate cause changes in other rates and have a big impact on the economy. But let me help you how this happens, how this open market operations and federal funds rate are related. So when Fed starts selling or buying bonds, it's actually trying to affect the supply and demand of the bonds in the market by playing with the federal funds rate. The details of how federal funds rate and open market operations are related is a little bit advanced topic, but what you need to know is federal funds rate, any change in federal funds rate cause changes in other rates and have a big impact on the economy. In the following slide, you see that when federal funds rate is changing, mortgage rate, prime rate, 3 months T-bill rate all moves accordingly to the federal funds rate, okay? So that's an important tool that Fed is actually affecting the interest rate and money supply through federal funds rate, and this federal funds rate in return affects all other interest rates. Here is how federal funds rate and monetary policy is related, which I'm not going to talk about this part a lot. And let's look at the summary. Money serves, we learned that money serves three functions: medium of exchange, unit of account, and store of value. And we learned that there are two types of money: commodity money, which has an intrinsic value, and fiat money does not. And the US uses fiat money, which includes currency and various types of bank deposits. And we learned that banks create money, and how banks create money is a big topic in this chapter. And it happens, the bank create money in a fractional reserve banking system, and banks create money when they make loans. Bank reserves have a multiplier effect on the money supply. And because banks are highly leveraged, a small change in the value of banks' assets causes a large change in bank capital. To protect depositors from bank insolvency, regulators impose minimum capital requirements on the balance sheet of the bank. And then we talk about Federal Reserve. The Federal Reserve is the central bank of the US, and Federal Reserve is responsible for regulating the monetary system. The Fed controls the money supply mainly through open market operations by selling and buying bonds, which will increase the money supply or decrease the money supply. So you need to know how buying and selling bonds will affect money supply. In recent years, the Fed has set monetary policy by choosing a target for the federal funds rate. So this is all about this chapter. What you need to know for this chapter: understand how banks create money, understand the role and structure of Federal Reserve, and understand the definition and functions of the money.